Picture two houses on the same street in Columbus, Ohio, same neighborhood, same square footage, same school district. Two men who went to the same college, graduated the same semester, took jobs paying within $3,000 of each other, $74,000 a year. Marcus signed papers on a $420,000 home. 5% down, 30-year mortgage. Monthly payment, $2,450. He told himself he was doing what adults are supposed to do. Derek bought a $210,000 townhouse. His friends thought he was settling. Monthly payment, $1,190. 22 years later, Marcus is still working. He has to be. Derek retired at 57. This isn't a story about income. It isn't a story about real estate. It's a story about the most expensive decision most Americans ever make, and why the advice everyone gives you about it is quietly, systematically wrong. The mortgage isn't the asset. For most people, the mortgage is the trap. Today, I'm going to walk you through 5 ways your mortgage is draining your financial life, not just through the payment you see, but through the hidden costs most homeowners never calculate. These aren't about renting forever or never owning property. They're about understanding what that monthly payment is actually costing you when you follow the money all the way to the end. Let me introduce a concept that will change how you read every mortgage statement you ever receive. I call it the true cost multiplier. Most people look at a mortgage and see a monthly payment. What they don't see is the network of second costs attached to it: property taxes, insurance, maintenance, opportunity cost on the down payment that collectively equal or exceed the payment itself. Here's what's really happening. In the first 10 years of a standard 30-year mortgage, roughly 80% of every payment goes to interest. On a $420,000 loan at 7%, you'll pay $196,000 in interest before you've paid down $50,000 in principal. You are paying to borrow money far longer than you're paying to own the house. The price on the listing is not the price of the home. The price of the home is every dollar you pay over the entire term divided by the years you actually live there. Rule 1, the interest illusion. Your mortgage payment is not building wealth. It's servicing debt. Mortgage amortization is structured so lenders collect the most interest early, when your balance is highest. On a $350,000 mortgage at 7% over 30 years, your total interest paid is $488,000. You borrow $350,000 and repay $838,000. The home has to appreciate by $488,000 just to break even on financing alone. Marcus paid $87,000 in his first 3 years. Only $11,000 reduced what he owed. He watched his equity statement and felt progress. He was watching the wrong number. Rule 2, the invisible tax bill. Property taxes are a permanent second mortgage, one that grows every time your neighborhood improves. The average American homeowner pays $3,900 per year in property taxes. In Illinois or New Jersey, that number routinely exceeds $9,000. That's $750 per month before you've touched the mortgage. And unlike your mortgage payment, this one never ends, and it rises with assessed value. Marcus saw his home appreciate from $420,000 to $610,000. His property tax bill grew from $6,300 to $9,100 annually, an extra $235 per month that compounded silently every year while he celebrated his rising equity. Rule 3, the maintenance monster. Budget 1, 2% of your home's value annually for maintenance. On a $400,000 home, that's up to $8,000 a year, $660 per month, in costs most buyers have no cash set aside to absorb. The Federal Reserve's 2023 Survey of Consumer Finances found 37% of homeowners cannot cover an unexpected $400 repair without going into debt. When the HVAC fails or the roof goes, and they will, that cost lands on a credit card at 22% interest, resetting your financial timeline. Derek paid a $320 monthly HOA that covered exterior maintenance, roof replacement, and landscaping. Marcus paid nothing like that because he paid everything like that, unpredictably and at the worst possible times. Rule 4. The opportunity cost nobody counts. A $50,000 down payment placed into a diversified index fund at age 32, left untouched, compounds at 8% annually to $620,000 by age 65. That same $50,000 in a down payment does not compound. It reduces a loan balance, but the equity it creates is illiquid, subject to transaction costs, and earns no return until the day you sell. Derek put $21,000 down. He invested the remaining $29,000 he'd saved. By age 57, that $29,000 had grown to $286,000. That was part of how he retired 11 years before Marcus. Rule 5. The upgrade trap. The most financially destructive moment in most homeowners' lives isn't the first purchase. It's the second. You build $80,000 in equity, step up to a larger home, and reset everything. Bigger mortgage, higher taxes, more maintenance, and you're back in the interest-heavy early years of amortization all over again. The National Association of Realtors reports the median homeowner stays just 13 years, meaning most Americans sell before principal paydown accelerates, pay 5-6% in realtor commissions, and restart the clock. Marcus upgraded at year 8. His new payment, $3,100 per month. He called it an investment. It was a decision that delayed his retirement by 11 years. Both men earned $74,000 at 30. Both saved $55,000. Marcus spent $3,700 per month on housing, mortgage, taxes, maintenance. He could invest $200 per month. Derek spent $1,710 per month on housing. He invested $1,600 per month from day one. By age 52, Marcus held a $610,000 home with a $180,000 mortgage balance and a $212,000 investment portfolio. Net, $642,000, but $430,000 was locked in a house. Derek's $340,000 townhouse was fully paid off. His investment portfolio, $1,180,000, net liquid wealth, $1,520,000. The mathematical difference was not income, it was not luck. It was different definitions of what a home is for, and that single distinction compounded for over 2 decades. Here's a practical plan you can start today. This week, run your true cost multiplier. Add mortgage payment, monthly property taxes, average maintenance, 1.5% of home value, the 12, and insurance. That's your real housing cost. This month, calculate the opportunity cost of your down payment. Apply 8% annual growth and projected to age 65. Compare that number to your projected home equity. The gap will tell you something important. This quarter, if you're considering an upgrade, model the new total housing cost against the old one. Calculate what the monthly difference, invested instead, would be worth at retirement. This year, make one extra mortgage payment. A single additional principal payment per year on a $350,000 mortgage at 7% reduces total interest paid by $61,000 and cuts 4 years off your loan term. People who apply this framework consistently for 25 years retire with more freedom than their peers at every income level, not because they earned more, but because they understood what they were actually buying. Here's what nobody tells you about choosing a smaller, more affordable home. From the inside, it feels like settling. The cultural script is loud. Your home is how the world measures your success. Buying less than the bank will approve feels like announcing you couldn't do better. Here's what it actually is: margin, flexibility, the ability to invest the difference, the freedom to leave a job that's making you miserable without a $3,700 monthly housing cost standing between you and the door. This relationship works in both directions. Living below your housing means builds slack into every financial decision that follows. Living at the limit of your approval means every shock, job loss, medical event, market downturn, lands directly on your largest fixed expense with nothing underneath it. The choice between these two cycles determines financial security more than income, more than timing, and more than any investment strategy you will ever find in a personal finance book. Picture yourself at 65. In one version of that future, you're carrying a $140,000 mortgage balance into retirement because you upgraded twice and reset the clock. Fixed expenses run $3,400 per month before groceries or medicine. Social Security covers 2/3 of that. You're working part-time, not by choice, but because the math demands it. In the other version, your housing costs were settled in your 50s. Your portfolio has been compounding uninterrupted for 30 years. You make decisions based on what you want, not what you can still afford. Both versions of you bought a home at 30. Both had good intentions. Both are living with the consequences of what they chose to optimize for. Which version you become depends not on income, not on the market, not on luck, but on whether you understood what you were actually buying when you signed. The goal was never the house. The goal was always what the house was supposed to give you: security, freedom, peace of mind. Most people spend 30 years paying for the appearance of those things and never notice the difference until it is far too late to course correct. The ones who actually get them spend 30 years understanding the difference and making decisions based on what the math says, not what the culture says they deserve.